You know, a trading strategy is like the master blueprint for our trading performance, yet without precisely pinpointing the entry and exit points for each trade, that blueprint can feel a bit, let's say, incomplete. Now you might be wondering, so how do we find these ideal entry and exit points that fit our trading style and strategy? Well, in today's video, I will share the 4 strategies that have proven their worth in my own trading journey, the strategies that I'm confident in that can guide your trading decisions towards more profitable outcomes. So without further ado, let's begin. You know, I often compare trading as if it's like baking a cake. You need the right ingredients, which are your analysis, a proven recipe which represents your trading strategy, and perfect timing for your entry and exit points to ensure that the trade doesn't burn. And just as you wouldn't toss your ingredients into a bowl and hope for a great result, diving headfirst into a trade without a clear plan can lead to confusion and worse, significant losses. I always believe that a well-defined trading entry and exit strategy provides us with the outline we need to manage the volatility of the market. But what happens when we trade without a proper plan? Imagine walking a tightrope blindfolded. Well, that's what trading without a solid strategy feels like. It's risky, stressful, and more often than not, it leads to a fall. So now that you understand the importance of a trading plan, let's dive into our first strategy, which is the power of moving averages, and particularly the 20 and 50 period moving averages. Here's how it works. I always keep an eye when the 20 period moving average, which is the faster one, crosses the 50 period moving average, which is the slower one. When the 20 period average rises above the 50 period average, it often signals an upward trend. This might be just a perfect opportunity to enter the trade, riding the wave as it starts to rise. On the flip side, if the 20 period average dips below the 50 period one, it could be an indication of a downward trend. This might be your signal to exit your position to avoid getting caught in the downward spiral. You know, it always sounds so simple, right? But as you know, the market is anything but simple. Sometimes it throws us curveballs in the form of false signals. These can mislead us into believing a trend is starting when in reality it's not. This is where the importance of cross-verification comes in. So to increase our chances of success and filter out these false signals, I always combine moving average signals with other indicators or patterns. This could be technical indicators like RSI or MACD, or perhaps price action patterns. So that's why if you have followed my signals or observed my trades, you will often see me waiting for additional candlestick confirmation. So for example, a bearish or bullish engulfing candle bouncing off the moving averages can provide that extra assurance for my entry or exit decision. Consider one of my recent VAP trades on Euro JPY. So on the weekly time frame, the price bounced off the 147,200 level, indicating bullish pressure. And on the daily chart, the price breaks through the 20 period moving average, and on the 1 hour chart, we had a bullish engulfing closure bouncing off the 20 period moving average. So this was my cue to enter the trade, which ultimately resulted in a profit of 160 pips. I always say that in trading, every bit of extra confidence can be crucial, and utilizing these moving averages complemented by candlestick confirmation has proven to be a valuable strategy in my own trading sessions. So the next strategy involves utilizing support and resistance levels for effective trade entries and exits. I always consider support and resistance as the floor and ceiling of a room, respectively. The price tends to bounce between these levels, creating a range of trading opportunities, and to effectively enter and exit trades using support and resistance zones, it's important to follow an advanced approach. So what I do is I always begin by identifying significant support and resistance levels through a careful analysis of price data. So these levels represents the areas where the price action has previously reversed or encountered obstacles, and as long as it has 3 or more rejections of the level, the stronger and the more reliable it is. So when I have pinpointed potential support or resistance areas, I always cross-check my findings with additional indicators or signals. This can include those candlestick patterns we have talked about earlier, along with the trend lines, moving averages, and other technical analysis tools. So to give you a better understanding, picture this. The price approaches a support zone and starts showing a signs of rejection. This could be our chance to enter a long position. I always look for bullish candlestick patterns such as hammer, bullish engulfing, or piercing patterns signaling an upward shift. And for extra assurance, I may use the stochastic oscillator to spot oversold conditions along with the 20 and 50 period moving averages. Conversely, when the price reaches a resistance zone, it may be an appropriate time to exit exit a long position. I always watch out for bearish candlestick patterns like a shooting star, bearish engulfing, or evening star patterns suggesting a possible reversal. Additionally, if the price fully breaks below the moving averages, this also gives a strong hint that the sellers are getting in control and it's time to make a move and exit the trade. So the next powerful strategy on my list is price action, and you know, price action is the market's language as it speaks us through the ups and downs and its highs and lows. Knowing how to recognize and analyze price action is like having insider knowledge of the market, allowing us to make wise judgments depending on how the market is moving. I found that unique patterns and candle formations often offer critical insights into potential entry and exit points. And of course, certain price levels can also hold significance, often acting as psychological barriers where the price may experience resistance or support. So let me give you an example. Imagine you're analyzing currency pairs such as Euro USD. You notice a strong overall bullish trend in this pair with higher highs and higher lows being formed over time. And as you continue monitoring the price action, you spot a double bottom pattern forming near a key support level. This pattern suggests a potential reversal and could signal a bullish move. And of course, to confirm your analysis, you observe a bullish engulfing candlestick pattern breaking the double bottom neckline. So combining these price action signals, the overall bullish trend, the double bottom pattern, and the bullish engulfing candlestick, you decide to enter a long trade on the Euro USD currency pair. And over the following days or weeks, you see the price of Euro USD steadily rise, aligning with your analysis. So with this example, I just wanted to highlight how price action analysis in trading can help identify potential trading opportunities and guide decision making. Now let's dive into the last strategy I want to discuss with you all, which is entering and exiting trades using profit objectives. This strategy is all about setting clear goals for your trades and effectively managing them to maximize your profits. So what exactly is a profit objective? I always think of it as the destination or goal you set for the trade, as it represents the level of profit you aim to achieve. So let's say you are trading a currency pair like GBP USD, and as for each trade, setting a profit objective is vital. So for example, if your trading strategy suggests an average profit potential of 80 pips per trade, you can set a profit objective of 80 pips before entering the trade. And as the trade unfolds, keep a close eye on the market conditions and analyze the price action. If the currency pair exhibits strong bullish momentum and no immediate resistance, it may be wise to let your profits run by aiming for the full 80 pips profit objective. However, if you notice the currency pair approaching a significant psychological resistance level or showing signs of a potential reversal, it's a good idea to be flexible and adjust your profit target. You can even consider closing the trade at predetermined level like 60 pips, which allows you to secure a substantial portion of your potential profits. So by defining your profit objectives in advance and effectively managing your trades based on the market conditions and analysis, you can optimize your trading outcomes and increase your potential profits. So here you go, guys. These are my 4 tried and tested strategies that I'm using on my day-to-day trading basis, and if you found this video helpful, don't forget to like and comment down below. Make sure to join our Discord community, follow me on Telegram, and if you're interested diving deeper in my own trading journey, make sure to click this